Good evening and welcome to Qnews Economic Bulletin. We bring you the latest top economic stories along with expert analysis on the events and trends shaping the regional and global economy. Throughout our coverage, we spotlight key sectors and highlight the defining economic developments of the moment. To start with the latest headlines, we'll hand over to my dear colleague, Henny Saif, for the top economic stories. What do you have for us, Henny, today?
Thank you, Rana. We do have plenty of news and developments from around the world, but we'll start off with the intercontinental trade as the India-UK Comprehensive Economic and Trade Agreement has entered into force, reducing tariffs on thousands of goods and expanding market access for businesses in both countries. Britain will remove tariffs on 96.8% of tariff lines immediately, while India will eliminate duties on 64.1% of products and gradually reduce tariffs on more. The agreement is expected to boost trade in goods and services, with bilateral goods trade exceeding $25 billion in India's 2025-2026 fiscal year and services trade reaching $35.4 billion in 2024.
Pro-innovation and pro-growth. It's a force multiplier and a template for future trade agreements, as I believe.
In Asia, Information Minister Ashwini Vaishnaw has announced that India's cabinet has approved a 1.28 trillion rupee expansion of its semiconductor program to boost chip manufacturing. The funding will support semiconductor design, intellectual property development, new fabrication plants, and research and development. The cabinet also approved 625 billion rupees for a 5-year incentive program to expand mobile phone manufacturing, which is expected to create around 60,000 direct jobs. In the MENA region, Saudi Arabia's annual inflation rate remained unchanged at 1.8% in June, supported by stable consumer prices despite continued increases in housing rents and personal care costs. The General Authority for Statistics has reported that the consumer price index rose 0.2% on a monthly basis compared to May. Inflation has remained within a narrow range of 1.7% to 2.3% over the past year, easing from a peak of 2.3% in August of 2025 before stabilizing around current levels. Jordan's cabinet has approved new rules for its investor citizenship and residency program, aiming to attract long-term investment and encourage projects outside the capital. The government raised the minimum investment required for citizenship through the Amman Stock Exchange to 1.5 million dinars, while lowering the capital requirement for productive projects in the governorate to 500,000 dinars compared to 700,000 in Amman. The revised framework also links citizenship eligibility to job creation, with incentives for businesses that employ Jordanian workers as part of efforts to support regional economic development and attract higher quality investments. In Africa, the National Bank of Angola has cut its benchmark interest rate by 125 basis points to 15.75%, marking its second rate cut in 2 months as easing inflation outweighed global economic uncertainty. Bank data also showed that annual inflation slowed to 10.11% in June from 10.88% in May, prompting the central bank to lower its year-end inflation forecast to 8.6% and slightly raise its 2026 growth forecast to 3.6%. The bank also approved the Chinese yuan as an eligible currency for bank's foreign reserve requirements, reflecting its growing role in Angola's trade with China. In North America, U.S. producer prices fell 0.3% in June, marking their biggest monthly decline in 14 months, driven by lower energy costs. The annual producer price index slowed to 5.5%, down from 6% in May, adding to evidence that inflation had eased before the recent escalation in Middle East tensions. The data reinforced expectations that the Federal Reserve will leave interest rates unchanged this month. However, economists warn that rising oil prices linked to the US-Iran conflict could renew inflationary pressures later this year. In Latin America, Statistics Agency IBGE said Brazil's services sector contracted 0.4% in May from the previous month on a seasonally adjusted basis, missing economists' expectations for a 0.1% increase. The decline was driven by 1% drop in transport services and a 1.9% fall in other services. On an annual basis, services activity rose 0.4%, as below market forecasts of a 0.9% increase. In commodities, oil prices fell on Wednesday, shrugging off a new wave of U.S. attacks against Iranian military installations that aim to limit Tehran's ability to strike shipping in the Strait of Hormuz and taking heart from a smaller than expected drop in U.S. crude oil inventories. Brent futures fell 1.31% to $83.62 a barrel. West Texas Intermediate futures lost 1.02% to $78.53 a barrel. Gold prices trimmed losses on Wednesday after U.S. producer prices unexpectedly fell in June, although worries about inflation and elevated interest rates remained due to escalating tensions in the Middle East. Spot gold was down 0.2% at $4,047.27 an ounce after falling nearly 1% earlier in the session. U.S. gold futures fell 0.4% to $4,053.7. Among other metals, spot silver dipped 1.6% to $57.67 an ounce. Those were the top financial and economic stories we have for now. So it's time to go back to Rana Al-Assas in our studio. Rana.
Thank you so much, Henny. Now we move to our in-depth analysis. The rules of the global economy are being rewritten. While inflation is easing, geopolitical tensions, rising debt, and the rapid advance of artificial intelligence are reshaping the economic landscape. As the International Monetary Fund calls for credible policies and stronger international cooperation. So what these shifts mean for the global economy? Let's take a closer look. The International Monetary Fund's new strategy director, Christian Mumsen, has urged governments to maintain credible fiscal and monetary policies to preserve price stability amidst growing global uncertainty. Mumsen noted that the global economy has been hit by repeated shocks, including the COVID-19 pandemic, trade tensions, and the wars in Ukraine and the Middle East. He added that rapid advances in artificial intelligence and digital finance are reshaping the global economy. He further called on governments to maintain sound public finances, strengthen resilience to supply disruptions, and prompt international cooperation to ensure AI supports inclusive growth, despite an increasingly fragmented global order. And for more analysis and details on this topic, we're joined from London by global economics and chief market strategist of Longview Economics, Chris Watling. Welcome, sir, to Qnews, and it's a pleasure to have you, our distinguished guest today, on this very special topic. The IMF, sir, is urging governments to maintain credible fiscal and monetary policies. At the same time, recent inflation has been driven largely by supply-side shocks rather than demand. Does this require central banks to rethink their traditional monetary policy framework?
Well, I mean, there's a lot in that question. I think they're concerned about the supply-side shocks, as you said, and there have been a series of them, and certainly in the way central banks think about inflation and controlling prices, they want to lean against the wind, and they're concerned about inflation expectations becoming embedded and an inflation mentality becoming embedded in the economy. So yes, they are rethinking and doubling down on ensuring inflation expectations are kept under control. I'm not sure that that's the right approach in this instance, but that's certainly what we're seeing from central banks. And we saw the European Central Bank a month or so ago raise interest rates as a result of the oil price move from the Iran war. They're talking about raising interest rates again. And some of the people at the Fed have been making more hawkish comments, and similarly at the Bank of England and other central banks around the world. So yeah, they are responding to what they see as supply-side shocks. So the reality is you can't control the oil price specifically as a central bank. You can't control specific food prices. You can only control overall inflation. So it's a very difficult thing to deal with, and economists are split on the best way to do that. But yeah, I mean, they're certainly doubling down. And as you said, the comments from the IMF head today are indicative of that.
With geopolitical tensions reshaping global supply chains, sir, are we likely to see permanently higher production costs? What would that mean for inflation, interest rates, and long-term economic growth?
Well, what you're basically doing is you're unwinding efficiency in global supply chains. So you're unwinding price deflation and adding in inflation into the system by making the global supply chains more inefficient. And that's essentially what reshoring does. You stop manufacturing goods and certain services in the most cost-efficient parts of the world, and you bring them back onto shore, whether it's in America or Europe or somewhere else. So you add in inefficiencies, you add more inflation to the system. But what that does is it means you get less growth, and your mix of nominal GDP growth changes. You get less real growth, a little bit more inflation. But if the central bank does its job properly, it controls that inflation because it controls the money supply. And actually what you end up is with lower nominal GDP growth. So lower real GDP and lower nominal as well. So the inefficiencies are not good in the long term. You're taking away from long-term economic growth. But the central bank can deal with the inflationary consequences of them as long as it takes a sensible approach to dealing with the money supply growth in the economy.
Sir, you mentioned the central bank, of course, if it does its work properly, of course, everything is going to get better. This was your statement. In light of the geopolitical, of course, instability that's taking place now in the Middle East, Iran, the United States, how do you read how, of course, the International Monetary Fund, inflation, and, of course, global economic catastrophes all over the world?
Well, I mean, as I say, they're negative for global growth. We're in a world that is deglobalizing, really from say the fall of the Berlin Wall in 1989, all the way through till, let's call it 10 or 15 years ago, perhaps the global financial crisis. The world became more globalized. China entered into the global trading system. It applied to join the WTO, the World Trading Organization, in 1995. It joined in 2001. Its exports to the rest of the world grew enormously, such that its global market share of exports 30 or 40 years ago was 2 or 3%. It's now the biggest world exporter out there. So China's exported a ton of deflation when it joined the global trading system and when globalization kicked in. But since the global financial crisis, we've steadily grown apart. The world's become more multilateral. Some barriers have come up. The US has brought in tariffs. China's reacted. There's become a multilateral world rather than a US-centric world. And as a result, we're in a phase of deglobalization. Just look at China's exports to the US. They're down dramatically in the last few years as an example of that. So all of that brings in inefficiencies. And the more you have geopolitical crises and oil price shocks and geopolitical challenges, the more it enhances that, and it enhances politicians' desires to deglobalize and reshore and unwind global supply chains and all that sort of stuff. So, politicians talk about, security of food supplies, security of energy supplies, and security of this and that, and so on. And all of that is basically unwinding global supply chains, or some of them. And as I said, adding inefficiencies and therefore adding in inflationary pressure that central banks can deal with if they so choose. So I think that's the way to think about it. We've gone from a long phase of globalization. We're now in an unwinding of that in a long-term deglobalization phase.
Got your point, sir. All respect and noted. Many governments are investing, as you mentioned, of course, China. Many governments are investing heavily in strategic sectors such as semiconductors, clean energy, and AI. How can they support these industries without creating market distortions or unsustainable fiscal burdens?
Well, I mean, it's challenging. I mean, it's not, governments, typically the rule is typically we see in history when governments get involved in investing in the private sector or private industry, they add inefficiencies and they don't do it terribly well. Generally the rule is that's not a good thing to do. There are ways of doing it, and some governments have had some degree of success, and there's certainly an argument for governments supporting R&D in economies and encouraging R&D and supporting that through the tax system. But generally, I don't think it's a terribly good way to go about things, and you tend to end up with more inefficiencies as a result. But yeah, I mean, there are a handful of good examples, but I would suggest that Trump's policy is gone way too far. The desire to push into ownership by the US government of several private companies. We saw that with Intel. There's talk about OpenAI. This generally isn't a good way to efficiently invest in the private sector.
Okay, sir, you mentioned challenges. To which extent do you see these challenges, and how do you read them?
Challenges in what sense? Sorry, in what terms? In which area?
I asked you the question, sir. You said, of course, many are meeting a lot of challenges.
Well, I mean, there's a lot of challenges with governments getting involved in the private sector because they have dual incentives. It's not just a case of trying to make money. This is why private sector businesses tend to do so much better. Take the UK. I mean, the UK's productivity of the government sector is, in fact, down over the last 25 years. It's become less productive in absolute terms. There's been negative productivity growth, if you like. So as an example, that governments have skewed incentives. Politicians wish to appease electorates in democracies, or in authoritarian governments, there's often degrees of corruption whereby some of the leadership are looking to enhance their own wealth through their powerful position, again, which builds in inefficiencies. So yeah, I mean, governments are not good at running companies. I mean, that's the bottom line. I mean,
okay, sir, as you mentioned, the United Kingdom, of course, the United Kingdom was a country, of course, with, of course, amazing economic interest, and it was a country that was always pointed out to. How do you read what's going on in the United Kingdom at this point, as of course an international analyst that we're discussing with, of course, and we respect so much? Do you think that the United Kingdom will get out of this disturbance that's taking place in the country, and of course the inflation, of course loss of employment or unemployment, and of course on top of all, everything that's happening in its economics?
Yeah, I mean, the UK is struggling at the moment. There's no two ways about that. As you said, the employment market is poor, unemployment's going up. Inflation is actually probably better than it seems on the surface and is closer to target. But there's little growth in the economy, and it is very challenging. So will we ever get out of it? Yes, of course we will. I'm sitting here in London right now, and there's certain parts of London that are really quite buzzy. If you look at the venture capital industry in the UK, it is larger than the next two big centres. London is larger than the next two big cities in Europe combined in terms of venture capital. The amount of money invested in venture capital last year was as much as it was in the 10 years running up to Brexit. So good things are going on. There's a lot of innovation in the UK, but it's just we have a government sector that's too big at the moment, and it's crowding out parts of the private sector. So we need a sensible government, and unfortunately, I don't think we're about to get.
Do you think, sir, you're gonna reach the point? Of course, I'm not. I'm out of the core of our discussion. I'm very sorry, but because London or the United Kingdom is a country that's really close to my heart. Do you think that this is going to be resolved soon?
Well, the chat around
one of the main issues that nobody understands when it comes to discuss the United Kingdom is the VAT, of course, and nobody understands why the value-added tax has been, of course, for the people that do not live in the United Kingdom, is now done with and over, and no VAT in the United Kingdom, so they go and travel to different countries in Europe and spend their money there.
Yeah, I mean, there's some policies that don't make sense. We've had some bad policy.
So you see, sir, and you read that it doesn't make sense.
Well, if you're talking about charging VAT to tourists, yes, I think that's a strange policy. But there's been quite a few other strange policies in terms of discouraging international people to come and live here by changing the tax regime, the non-dom regime, and all sorts of things like that. I mean, the best countries to live in are those with low regulation, low taxation. And the UK has been moving away from that for 15 years. But let's not forget we had two major crises.
What you're saying, of course, I don't want to get into this discussion thoroughly now. We can make an entire, of course, episode about this. But not, of course, we have, of course, millions of students which live in the United Kingdom and learn in the United Kingdom and are educated in the United Kingdom. And these do not get value-added tax, and we do not ask for this. But the normal citizen that travels to the United Kingdom for tourism has to get value-added tax like any country in Europe.
Yeah, so I don't quite understand your point. I mean, if you spend money in the UK, you will pay VAT. If you buy goods, you can claim it back, I think, at the airport. I'm not fully aware of all the rules, but that is not the nub of the problem. The nub of the problem is much bigger than that and multifaceted.
But it's only because we don't understand it today, sir, why the value-added tax in the United Kingdom, and everybody loves the United Kingdom so much. And this would enhance shopping, which would enhance a global economy, or will enhance the economy in the United States. Sir, before I leave you in 10 seconds, because I have to wrap up now, or they're going to be killing me from London. Of course, looking ahead over the next 5 years, what do you see as the single biggest challenge facing the global economy, and what policy response should governments adopt now to prepare for it?
Well, there's a couple of possibilities. Certainly one of them is that AI displaces a lot of labor, and governments have to deal with significant amounts of unemployment. That is a serious challenge. It requires multifaceted answers, one of which is retraining. Another is, interest rate policy and so on. But there's also a challenge in that, we have a very large fiscal deficit in the US and very large government indebtedness. I think that could become an issue, especially if you look at the stock market in the US, which I would argue is in a bubble. And at some stage that will burst. I'm not suggesting bubbles have to burst immediately, but it will happen in the next 2 or 3 years. And that will cause a lot of challenges as well. So some mix of those, I think, are part of the challenges the global economy faces. More immediately is still the issue of the oil and whether or not we get what's called tank bottom, which is parts of the world basically running out of oil. So there's a lot to worry about. There always is. But those would be some of the key issues.
From London, that was Global Economics and Chief Market Strategist at Longwing Economics, Chris Walting. Sir, I'm very sorry I mentioned you as an analyst in the middle of the episode. And again, please accept my apologies. And thank you very much for your in-depth analysis and for your, of course, informative intellectual knowledge. And on a lighter note, please consider the VAT, sir. And dear viewers, now we turn on to the fans' favourite, as all eyes remain on the 2026 FIFA World Cup. The final whistle has blown, but the economic game is just beginning. From Atlanta to Canada, officials are now measuring whether the 2026 FIFA World Cup delivered more than unforgettable matches that generate lasting jobs, investment and economic growth. Let's take a closer look. Atlanta leaders expect the 2026 FIFA World Cup to deliver a lasting economic boost to the region. Before the tournament, the Metro Atlanta Chamber projected the event would generate more than $503 million in economic activity across Georgia. While final attendance and economic figures are still being complied, early indicators point to a strong economic impact. And Emory, a university study, also estimated that Decatur's month-long watch feast could contribute up to $142 million to the local economy. Beyond its immediate economic benefits, Atlanta leaders also say that the 2026 FIFA World Cup has created opportunities to strengthen international business ties and attract long-term investment. Metro Atlanta Chamber Chief Economic Developer Officer Christy Brigman said organizers hope the tournament would lead to sustained investment in the region. Moreover, Senior Capital Investment Officer for Sports of the British Consulate in Atlanta, Thomas Woodley, stated that Consulate has worked closely with economic development organizations and government partners throughout the tournament to foster new business partnerships. Joining us now is Dr. Hassan Abdel-Fattah, Professor of International Systems and Business Analysis from Ohio. Welcome, sir, to Qnews, and it's a pleasure to have you with us. Hope you're enjoying the tournament. Yes, Atlanta projected more than $503 million in economic activity before the tournament. If you were evaluating the World Cup today, what three economic indicators would you look at first to determine whether it was truly a success?
Well, good evening and thanks for having me.
My pleasure, sir.
Well, I would begin with three major indicators. I would say the first will be net new spending versus public spending. So public return on investments and permanent economic activity. First, I would examine the net new visitor spending, as this is really important. So Atlanta's pre-tournament study projected the $503 million almost in economic impact for GA, focusing specifically on spending by international and out-of-state spectators and teams while excluding local and government spending. This is really important to be able to split the two different spending. That is more credible starting point than simply counting every transaction that took place during the tournament. We just need to split the two. Number two, or second, I would compare the additional tax revenue with the full public cost of transportation, security, sanitation, and event operation. Now, the United States received approximate $625 million in federal security support across its host markets. As you know, the FIFA World Cup games was everywhere in multiple states, different states, and also in Mexico and Canada. And this was demonstrating how significant the non-stadium costs of these events can become. Number three, or third, I would measure the permanent jobs, repeat tourism, and foreign investments over the next 3 to 5 years, such as hotel occupancy during 1 month is helpful, but it does not really represent a lasting economic legacy. Now, I would like to compare this to the Canadian approach. I've read the other days you were announcing they're trying to get some type of return on investments on what they spent for the FIFA World Cup. So Canada offers an important comparison before the tournament. FIFA projected up to 3.8 Canadian, 3.8 billion
Canada
Canadian
projected to the FIFA, sir?
So for the Canadian, so for Canada, FIFA projected up to 3.8 billion Canadian dollars in Canadian economic output, around 2 billion Canadian dollars in additional GDP. Now, the approximate 1.3 billion dollars or Canadian dollars in labor income, more than 700 million Canadian dollars in government revenue, and roughly about 24,000 jobs supported or created. Now, those are substantial projections, but Canada must eventually compare them with the public cost and determine how many of those jobs and investments remain after the event. So simply, or in plain English, if we were to compare apple to apple, we need to compare the pre-tournament income expenses, and then we compare local spending versus outsiders or visitors spending. The key distinction in this, gross activity tells us that the event was busy, not investment, and permanent employment tell us whether it was successful. And that's my 2 cents here.
Sir, many economic impact studies highlight visitor spending, but critiques argue that often overstate the benefits. In your view, what's the biggest misconception about the economics of hosting a mega sporting event?
It's really hard to be able to detect or determine return on investment as far as prediction. In a way, any investment will have return on investments, and usually we can give some percentage, 4 to 5%, 10 to 20%. The biggest misconception here is that every dollar spent during the World Cup represent a new dollar added to the economy. and that will increase the number of GDP. In reality, some local residents simply move their normal spending from one restaurant or entertainment activity to another. Well, some regular tourists and businesses travelers avoid the city crowds because of the crowds and elevated prices. Like, for instance, in Atlanta, not sure if you're aware, but Atlanta Airport is one of the most chaotic airports in the world.
Why is it
It's
one
really
of the most
busy.
chaotic airports in the world,
It's
sir?
it's really busy, always
Oh,
busy,
you mean busy or
always
chaotic?
in a busy way, in a busy way. As you know, like
So
in
you
the
mean
United States,
chaotic in a busy way?
in a busy way.
What
Yeah, you
about the
want to
New
get in
York
and out.
airport?
Actually, you know what? It depends on where you at in New York, JFK or the Liberty. I believe JFK is little hectic too, but in Atlanta, it's a bigger problem. It's really big airport, and it's always busy. So going back to, in addition to money spending or money spent on hotel, airlines, media rights, and hospitality packages leaves the local economy and flows to national corporations or FIFA. Now, that's why economists distinguish between gross economic output and net economic benefits. Across the three host countries, a FIFA and World Trade Organization's analysis projected about $80 billion in gross output, including about $30 billion in the United States. Another FIFA-related analysis projected up to $40 billion in GDP and approximately $824,000 full-time equivalent job globally. Now, these are enormous numbers, but they are model-based estimates. There are running simulations.
Got your point, sir. So let's move on to large sporting events often create surge in jobs and business activity, but many of those gains are temporary. What policies should host cities implement to convert short-term economic momentum into permanent growth and employment?
Well, I believe looking into these facts is I wouldn't be just aggressively given high number or high rate of return on investments prior to any investments. So we always look for long-term ROI, not just a temporarily ROI. For instance, if I'm going to spend billions of dollars on infrastructure, I would want to get return on investments for long term, not just for a short term.
Okay, sir, how can we get return on investment? Because every time this is what takes place. It is temporary, it is not permanent.
So I believe inviting large organizations, large corporations, inviting them to see our, hey, we're spending on infrastructure. We have the capacity to be able to invite not just tournament, we can invite practices, we can just encourage local businesses to support.
I think when it comes to the United States and Canada, technology is much more ahead of bringing investors to watch what's going on in the country. So Canada hosted fewer matches than the United States, yet many argue it still benefited significantly. Does hosting more games automatically mean greater economic return, or can a smaller host generate more value through smarter playing?
Well, I believe Canada will benefit more as if you compare the GDP, the Canadian GDP versus US GDPs, US GDP is $31 trillion. I mean, we have 350 million people versus how many in Canada? 41 million. So for Canada infrastructure, the support broader economic connectivity to reinforce its position in finance, technology, and AI.
Okay, great, sir. Because of all what you mentioned now, That's why Canada grabbed more investments than the United States.
Well, Canada have more, it's more appealing or more attracting economy as it's only, again, it's only 41 million people.
Got
They
your
have
point,
more
or sir,
infrastructure.
because Canada is more trustworthy at this point of politically when we're discussing, of course, the war that's taking place between Iran and the United States.
It's
Maybe
kind of
this is
stable
one of the
too.
reasons?
It could be one of the
Okay.
reasons they
Sir,
accept more.
go ahead, sir.
They accept more foreign investments without any restrictions, and they're attracting more businesses. The restrictions in the United States anymore with Trump administration
Okay, sir,
has
I
been
got your
really
point. It's
impacted.
about the restrictions in the United States. Maybe Canada is more Canada facilitates these businesses and investments, so it's easier. And maybe the war politically is another reason. On the other hand, I'm very sorry, sir. I have to end this discussion now because I have to end this episode. From London, that was Dr. Hassan Al Fateh, Professor of International Systems and Business Analysis from Ohio. Thanks you for your insights and for your intellectual and informative knowledge, and on top of all, sir, your time. That brings us to the end of our economic bulletin for today. Thank you very much for watching. Thank you very much for the of course, the editor-in-chief and editor that worked so hard on this episode. And stay tuned to Q News for the latest updates from all around the world of business, finance, and global affairs. And don't forget to follow our coverage during the World Cup, where we'll go beyond the action on the pitch to explore the business of tournaments, from sponsorships and investments to tourism, trade, and the economic impact of the world's biggest sporting event. I'm Rana Al-Qasas. Thank you very much for joining us and having a great day.